Welcome to FinLoop, your guide to smart investing. Hi everyone, and welcome back to FinLoop. Today, we're talking about a crucial aspect of investing, diversification. If you want to build a strong, resilient investment portfolio, understanding diversification is key. Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. The idea is that a diversified portfolio will yield higher returns and pose a lower risk than any individual investment found within the portfolio. Diversification is important because it helps spread risk. Imagine putting all your money into one stock, and that company performs poorly or goes bankrupt. You could lose everything. But if you spread your investments across different assets, industries, and geographies, the poor performance of one investment is less likely to have a significant impact on your overall portfolio. There are several ways to diversify your portfolio by asset class, industry, and geography. First, let's talk about asset class diversification. This means spreading your investments across different types of assets like stocks, bonds, real estate, and commodities. Each asset class has different risk and return characteristics. For example, while stocks might offer high growth potential, they also come with higher risk. On the other hand, bonds typically provide lower returns but are more stable. Real estate can offer both income and appreciation potential, while commodities like gold often act as a hedge against inflation. Next, industry diversification. Even within the stock market, it's important to invest in various sectors such as technology, healthcare, finance, and consumer goods. This way, if one sector underperforms, others may still do well, balancing out your returns. Then there's geographic diversification. Investing in different regions or countries can protect your portfolio from localized economic downturns. Now, let's look at the steps to create a diversified portfolio. First, assess your risk tolerance. Are you a conservative investor who prefers safety, or are you willing to take on more risk for potentially higher returns? Your risk tolerance will influence your asset allocation. Younger investors might have a higher risk tolerance, as they have more time to recover from market downturns, while those nearing retirement might prefer more conservative investments. Next, determine your asset allocation based on your risk tolerance, investment goals, and time horizon. A common rule of thumb is the 60-40 rule, which suggests 60% in stocks and 40% in bonds. But this can be adjusted based on your individual situation. For instance, a more aggressive investor might go for 80% stocks and 20% bonds, while a conservative investor might prefer a 50-50 split. Then, choose your investments within each asset class. For stocks, consider different sectors and geographies. For bonds, look at various types, such as government and corporate bonds. You might also include real estate through REITs or commodities like gold. For example, within stocks, you might invest in large-cap companies for stability, small-cap companies for growth potential, and international stocks for geographical diversification. It's also worth considering alternative investments like private equity, hedge funds, or peer-to-peer lending for further diversification. Finally, regularly rebalance your portfolio to maintain your desired asset allocation. Over time, some investments will grow faster than others, changing the balance of your portfolio. Rebalancing ensures you stay aligned with your risk tolerance and investment goals. For instance, if your stocks have performed well and now make up 70% of your portfolio, you might sell some stocks and buy bonds to return to your original 60-40 allocation. A well-diversified portfolio can provide more stable returns over the long term. It reduces the impact of volatility, as the poor performance of one investment can be offset by the better performance of another. Diversification doesn't eliminate risk entirely, but it's a powerful tool for managing it. Consider consulting with a financial advisor to help you create and maintain a diversified portfolio that aligns with your goals and risk tolerance. A professional can provide personalized advice, help you stay on track, and offer strategies to optimize your investments. Finally, diversification also involves diversifying within each asset class. For example, within your stock investments, diversify across different industries and company sizes. Within bonds, consider a mix of short-term and long-term bonds, as well as bonds from different issuers. Thanks for watching. If you found this video helpful, please like, share, and subscribe to FinLoop for more investing tips and insights. See you next time.